Hey traders, Clifford back with another video on how to trade the index. So today we're going to continue going over part 2 of how to use Fibonacci in your trading. Last time I had made a video, we spoke about how to adjust your Fibonacci levels. So today we're going to talk a little bit more about how you can really use Fibonacci to help you in your trading. So now, one thing I wanted to point out, someone in the comments had said that my levels didn't look correctly, and they were right. I said use the tool like this, draw from the top to the bottom. That's actually incorrect. That's backwards because you got the 0 level here and the 100% level here. Whoever pointed that out in the comments, thank you. It's actually like this. You start from the bottom and you draw to the top. Take the take the market low for the year is what move I'm measuring, and take the market high for the year and draw from the bottom to the top, and then all your levels will be correct. The 23%, 38%, 50%, 61, 78, and 100. All right. So with that being said, that's how you correctly draw on your Fibonacci. So now let's talk a little bit about the Fibonacci theory, right? Now, I'm not an expert in Fibonacci, but what I do know is that basically these levels are where the market can react, right? Based on support and resistance, based on numerical sequences and all the Fibonacci theory. But the main thing that I got out of the theory is that the market retraces to these levels. Now, the biggest and most important retracement, I think, in in um, in all of these different uh, levels here is the 50% level, and I talk about that one a lot because I've noticed that um, typically you'll see the market retrace 50% of its last big move. That's what Fibonacci teaches. So, like for instance, if the move was, let's just pull up a chart here. This is the Russell. Let's just grab this low and maybe uh, grab this high here. Or actually, we could use, maybe we'll use the S&P, I guess, either one. So what you're looking for is the low for the year and the high for the year, or whatever move you're measuring. I'm going to use this low right here and draw upwards. Again, always draw from the top to the bottom, like that person pointed out. And there you go, right? All right. So here's the bottom of the move. And actually, well, we could just use this one because this was the old high right here, before the market made a new high. So let's just use this one as an example. Low to the high, right? This is the all-time high back in July. So Fibonacci states that this big move right here will retrace at one point 50%. So where would 50% be? Well, if you got your bottom here and your top here, right there, 53.42. So what did the market do? It retraced. See that? It went from the high to the retracement area right there. And basically, when the market approaches these levels, these 50% levels, 38%, 23%, and all that, 61% or whatever, the market can actually do three things. It could pause, meaning it could just like hang out at the level. It could reverse, like bounce off the level, or it could smash through. So in this case, what did the market do? Well, when it got close to that level, it kind of reversed a little, but then the next day it broke through. Okay, so there's an example. What's another example? So that's we could look at, I guess we look at this one, the RTY, which is, by the way, the Russell. I only look at the four indexes, the Dow, S&P, Nasdaq, and Russell. But I guess it would apply to anything you're trading. But okay, so let's just go to this one real quick. This is the Russell here. So there we go. So here's the low of the move, right? Oh, I think I did it. Did I do it wrong again? No, I did it right. Okay, yeah. Because I'm used to drawing from the top down. Now I'm drawing from the bottom up. Okay, so here's the low of the move. Here's the high of the move, right? So low to high. look for a 50% retracement. And look what happened. Boom. There it is, 50%. So does that mean that you should automatically short the market expecting a 50% level, of expecting a 50% pullback? No, not necessarily. I mean, unless that's your strategy. But can it be done? Absolutely, it could be done. The beauty of this of Fibonacci is that, when I first started training many years ago, I used to use indicators. And for years I used indicators with a little bit of not much success. I mean, there was a little bit of success with indicators, but I just one day discovered a book on, I think it was price action, and the guy was saying in the book that you could trade without indicators. And I was like, well, that's amazing. And I started learning about things like support and resistance and Fibonacci rejection levels and things like that. And now I no longer use indicators in my trading. And you don't have to use indicators to trade. That may be a bold statement for some people, but it's true. You don't. And here's why. I'll show you. So let's say, okay, so here's the Nasdaq. Let's use this one, right? Let's pull it up. Here's the bottom. There's the top, right? And where's the levels? So I'll show you right now. 23%, 30%, 50%. Okay, so how would I trade this? Well, number one, I mean, if you're gonna short the stock market, the odds are usually against you. But I guess you could have, some people may short the stock market, and if that's your thing, you could definitely do it. But if I was gonna do it, I would use the Fibonacci levels to do it. Um, and how would I do that? Well, basically, if I see a rally and I see the market approach a Fibonacci level, right, then I would look for rejection at that level. So let's say, where's an example here? Let's see, an example. I really don't have one, but well, seasonally, like, let's see. Okay, so here's one. Here's one right here. So see the market kind of like rallied, right? But none of the levels got rejected. Here, you see that? See it hits the 61%, keeps breaking through. 50% breaks through. 38% breaks through. It starts to pause as it gets close to this one here, the 23%. So if you were gonna take a short, which again the odds are usually against you shorting the market, but you can do it sometimes and even have some success with it. I would wait for a signal like this. You see that right there? That is a bearish signal because it's rejecting the 38% level. See all these candles, like they're all breaking through levels, but here the market breaks below this level and then it tries to come back up but gets rejected at this level. That's a sign that the market doesn't want to go higher. So you could take a short there. You short at the close of that candle, put a stop loss above this candle here, and you would have a small profit. But then you got to be careful, and this is the problem with shorting equities. The buyers return really quick and sometimes violently. So as you see, as soon as it started selling off a little bit, boom, buyers just plunged back in the market and smashed it right back up. So, but how would I use this in my trading? Well, let's say I want to go long the market, which is always in your favor to go long the stock market versus short. But how would you do it without indicators, right? Well, again, we're looking at this chart and I'm looking for rejection. So if I see this candle here, where are we at here? 61.8%. The market closed below that candle. Would I be a buyer here? Absolutely not, because that is a bearish signal. What we want to see is a close above the 61.8% level. That's a bullish sign. And the more bullish, the better. So what would I do? Is this candle right here a signal to buy? I mean, kind of, but not really, because even though it closed here above the 61.8% level, it's not enough rejection for me to get confident that the market has bottomed and I'm going to have a potential outcome for a successful trade for the risk I'm willing to take. But see here, the next candle, it rallied and it tried to come back down, hit that level again, and reversed off it. So this signal right here, I would say it's worth taking a risk because number one, the odds are in your favor because it rejected the level. And then of course, if you waited for this signal, you would have lost a little bit of profit. But as you see, this is a huge rejection because it not only rejected it here the first time, it rejected it here the second time violently and closed all the way above the 50% level, which is the most bullish signal you can possibly get. And again, you don't need indicators for any of this. Um, so that's how I would use it in my trading. So like here's another example. Where's let me see. So like I mean, but that yeah, that's pretty much it. I mean, you just look for rejection off the levels. What is this S&P? Okay, so here's another one. So this is the 38% level, right? So here we had a bearish day. And this is why I don't believe personally in day trading, because if you're a day trader and the market opens here, boom, it plunges right on the open and you're excited. You're like, oh, yeah, this is great. I got in at a short and the market's probably going to go lower tomorrow. Well, no, because if you waited till the end of the day, yeah, it was a bearish signal. But again, you want to really look for rejection. Even though this is a bearish signal, it's not bearish enough to really say that the market, you know, is full on a bear market here. So if I were going to buy this market, which is what is this one now? The S&P we're looking at? Yeah. So again, here, boom, there's a bullish signal because it closes above this one here, the 38% level, right? But is it bullish to the point that we should really get excited? I mean, you could definitely take a risk here and put a buy order and put a stop loss below that candle, and you might have been all right. You might not have got stopped out. But again, the bigger the rejection, the more probability on your side. So like this candle right here, you could see it rejected the 38% level, then it rejected the 23% level. So this is a strong buy signal. You do not want to miss that because that is the signal. One more. So let's say you were, shorting the market. Okay, fine, you're shorting, you're making money. That's great. But you still want to watch out for the Fibonacci levels, even if you're short, because as you see, as it approaches some of these levels, the rejection can be violent. Here's the 78% level from this top of this move to from the bottom of the move to the top. Look what happened at that 78% level. Boom, the market reversed hard. And if you weren't watching this signal right here and you're still short, holding it short, this is a reversal signal. This is actually a signal that you want to pay attention to because the market's telling you that it doesn't want to go lower than this level for some reason. We don't know why, but either it's a psychological level or institutions are planning to buy at this level. Whatever the reason may be, you want to pay attention to that. So that's basically all there is for the strategy. You just pretty much watch for these reversal candles at your Fibonacci levels. And again, whether you're measuring the full move or a partial move, it can work both ways, and you don't need indicators to do it. Just remember the three things that can happen: the market can pause, it can reverse, or it can break through. So that's about it for this video. I hope that helps those of you who wanted to learn more about how to use Fibonacci in your trading, as well as what to look for in your charts. Again, I use the daily charts, but this could apply to, I guess, any time frame. And put your comments below, like, subscribe, let me know um, if you enjoyed the video, and look forward to seeing you guys in the next one. As always, trade what you see on the charts. Trade well.